price information. And I know on the next slide, we show a little of that kind of comparison that fundamental analysis, looking at the balance sheets, the cash flow statements, income statement, all that. That's what Jacob and I were talking about on Wednesday. Technical analysis is looking at past priced action. Now, big thing about technical analysis is it is not predictive in nature. It's not predicting what's going to come up with the future. Fundamental analysis can be a little bit predictive because you're coming up with your assumptions, you're coming up with your guesses on what you think earnings might be in the future, what you think revenue might be in the future. So to an extent, you kind of are predicting. Technical analysis is just looking at past price information. It's reflective. It's a lagging indicator. And with that, just real quick definition, so to speak. Next slide. This is the same slide I know we had in our presentation on Wednesday. Not going to rehash this. Again, fundamental analysis, just looking at fundamental information, looking at earnings information, looking at all this particular information that we spent an hour on Wednesday on, where technical analysis again looks at price. The important aspect is we then talk about the limits of fundamental analysis. Fundamental analysis, it can't help you with the timing of an investment. It can't really help you with the sell decision other than looking at it and saying, well, we think the price is going to be $100 a share and it's currently trading at $200 a share. So probably a good time to, not only sell it, but to go short, so to speak. But there's something interesting that I remember, reading about dealing with, the market can remain irrational longer than a trader can remain solvent. You might be right fundamentally, but the market can behave irrationally. The market can tend to trend one direction or the other. And we just have that quick bullet point summary of kind of those limits on the next slide. Again, this is a lot of what we talked about on Wednesday for the limits of fundamental analysis. But I do want to jump into, and I want to start to define a little bit more technical analysis, because this is something that we didn't really talk about on Wednesday. Now, one thing I do want to mention is, I talked a little bit about that, of course, that Jacob spent a lot of time, studying financial analysis, has a master's degree in finance. I've spent a lot of time studying to become a chartered financial analyst, studying for the CFA. But that said, a lot of people feel that it's one or the other. That you're either looking at the fundamental information and that's it, or you're looking at charts and that's it. And the fundamentalists would go, well, those chartists, they're just reading the tea leaves. That's mumbo jumbo. And the chartists would go, everything's priced into the chart. We don't need that fundamental information. And the reality is something very, very different. You'd be surprised at how much of an emphasis they put on technical analysis when I was studying for the CFA. That was actually a significant section of the material because of how it can help you manage risk. Again, technical analysis historically focuses on that past market data, the supply and demand dynamic from price. And you really only have two things. You only have two data points. You have price, you have volume, the number of shares that trade at that price. Everything else is really derived from that. How much was at one particular price point? Was there a lot of volume or not? Did price move a lot? How is price moving? And such. You're looking at these supply and demand waves. That's what technical analysis is seeking to do in its heart, is to kind of feel some of these waves, so to speak. Look at things like trend. And the big thing about indicators, and we'll get into this more in week 3, is indicators, they're going to be tools to help you analyze specific aspects of price. Now, on the next slide, we do talk about some of the limitations of technical analysis. For example, a lot of traders get caught up in looking for patterns and seeing things that maybe really aren't there. To an extent, our brains are wired that way, to look for patterns and such. But just because you might see what you think is a pattern doesn't mean it's going to actually behave that way. And there's reasoning behind a lot of these patterns that traders look for. And to an extent, it's more important to understand that reasoning, to understand why something like a head and shoulders forms, why something like a top forms, or a boxing pattern, or a V bottom, why traders look to follow trends and such. And you can't really be super precise with this. And there's a little bit of an art, a little bit to a science of this. And technical indicators, to an extent, are more science, so to speak, because you're doing the math, and it's either this or it's not. Where some of the patterns can be a little more art, that you might be looking at something like Elliott waves, and 3 different Elliotticians, well-known Elliotticians, might disagree on where everything starts. You might have 3 Elliotticians, but 5 different starting places, more than the number of people there are. And I see this happen all the time where and they could all be right, so to speak, with that. The big thing you want to be mindful of, though, is not letting yourself get caught up in the moment. Trade what you see, not what you feel, is one of those axioms that if you see price making lower lows and lower lows and lower lows, you don't jump in and go, I don't want to miss out. This is the pullback. Well, what are you seeing? Well, you're seeing price is making lower lows. We'll wait for it to stop making lower lows. Otherwise, you might be trying to catch that falling knife. And so it can be really difficult to to pull emotions out of everything. Now, with that though, Jacob, I know I've kind of covered a lot of information very quickly, dealing with some of those definitions and such. Anything that you might want to clarify a little bit more, or maybe talk about some of the assumptions?
Yeah, I think as we go through these assumptions, it will start to become a little more clear what we're really talking about when we say technical analysis. Lots of foreign terms that we've been throwing out. It will get more and more comfortable as we work through them and define more things. But here's what it amounts to, folks. Technical analysis is the study of past price data in order to understand what is happening now. A fundamental analyst might try and say what the company should be worth at some point in the future, when it grows, when their revenues change, when their competitors come out with competing products, and so on and so forth. A technical analyst assumes that the price that exists today already swallows all of that known information out there in the world, and people did their buying or their selling based on that information. And so the current price includes all that known information. Price discounts everything. That's what we mean when we say price discounts everything. What we mean is the current price is the fair price, is the right price. That's what a technical analyst assumes. They also assume that the prices, though they are not necessarily predictable, move around in a non-random fashion, in an organized way, you might say. Something that's visible. After all, the prices are the visible history of human behavior. And humans are humans. And we tend to make relatively similar decisions in relatively similar situations. As a result, we can start to apply this history and understanding of human behavior and then look for ways in which it may repeat the past. As a result, we could zoom in over a very short time span or very long time frames and apply this same idea. If people have acted this way in the past, it would be reasonable to expect that they might do the same this time. That's what this fractal business is talking about down here, that we can look at this on a very zoomed in, short scale, think hours or minutes long analysis, or zoomed way out to months or even years worth of data, all summarized together. But these are the types of assumptions that we are making as a technical analyst. Now, given that we had that preview to some of these ideas, learning fundamental analysis, for those of you who happen to have joined us in those previous sessions, that wasn't required though, folks, if we didn't make that clear. And now we're talking about technical analysis. Let me tell you that neither one nor the other is best. They are both actively used by professionals in the marketplace, technicals and fundamentals alike. The differences are the set of assumptions you're willing to swallow. And let me just poke holes in both of them equally for just one moment. A fundamental analyst says, I can determine the right price for the market, and that is not the current price. In other words, I am smarter than everyone else in the world. And I can make that analysis faster than everyone else in the world, fast enough that I can take action. Suppose I think the price is too low right now. Well, I'll buy it. And then I think that the rest of the world will agree with me by, like I already did, pushing the price upwards, allowing me to profit. Now, that's a pretty tall tower to look down at the rest of the world from. And as a result, sometimes fundamental analysis gets a bad rap. There is still substantial value in fundamental analysis. But let's do the same poking at the technical analyst world. It all comes down to price for the technical analyst, and it says that the price discounts everything. But we see evidence that that is not the case. For example, last night, Apple released their earnings, and then an hour or half hour later, they gave a conference call. Those were new amounts of information, and that was not known publicly by the trading and investing world until after that event. But once that information was announced, as of about 5 or 6 p.m. Eastern time last night, theoretically, the price should have stayed exactly the same because nothing else changed overnight. But the price wasn't the same. And we get minor additional amounts of information, and slowly people start catching up and reading and hearing what's been occurring. So even though we say that it discounts everything as technical analysis, well, it doesn't. Not everybody knows everything at the first instance that the information is publicly available. So be aware that on both ends there is faulty assumptions. You just simply have to decide if they are faulty enough that you're going to throw the baby out with the bathwater, or whether these are a particular pill you are willing to swallow in order to make your analytical decisions. Knowing that that's the backdrop, the foreground of where we are looking, let's now move to charts, chart types, and chart constructions. We're going to talk about some of the first ones, but the goal of a chart is to make a little easier for our eyes to visualize the patterns and trends that might be evident inside the data. Hard to tell if you are looking at an Excel spreadsheet of just number after number after number, what's really happening without some intense attention to detail. But we also are going to use it to analyze current price behavior. And there's a few ways that we can do that. There are charts that look like this, just a line, a scribble, the one you might have drawn with a pencil, drawn in over time, marking the price of a security over time. These line charts are very commonly used. Anytime you, for example, Google a stock ticker, that first chart that pops up, courtesy of Google, is a line chart or a variety of line chart called a mountain chart. Next is a bar chart. Bar charts and candlestick charts share almost everything in common. There's only one very minor difference between them. But the bar chart and candlestick charts can be summarized as what we call an open, high, low, close chart. That's because every single entry here represents 4 pieces of information. So Nick, I'm going to leave the slides here for just a moment. I'm going to head over to Active Trader Pro, where folks, we will be introducing you to exactly how this works. And we'll go ahead and zoom in and look at this information here. So this is the chart for Apple from a few days back. I zoomed in arbitrarily on this area just so that we can see it. The kind of chart that I have in front of you is a candlestick chart. Candlesticks represent, like I said, the open, high, low, and close. Now, the high and low part of that, you can probably guess. It's the price up here at the top of the little wick and at the bottom of this little wick. They were the highest and lowest prices traded during the course of that period. In this case, since I've selected a frequency of daily, we're looking at 1 day's worth of price action, and from top to bottom, that's our high and our low. The other 2 values are the open and the close. Open refers to the first trade that occurred during this period. In this case, the opening price would be the first trade at 9:30 Eastern time when the markets open for regular trading. And then the close would be the one at 4 p.m. Eastern time when the markets close their final bell trade at 4 p.m. They are also visible here, but it's a little difficult to understand them at first. Let me go ahead and change my chart setting instead to a bar chart so we can visualize this here. Here we've got the exact same information in front of us, but now we see it as a tick mark to the left. Do you see that small little tick mark right there? And a tick mark to the right. The one that's going to the left is the morning, the open, the start of this bar. The one that goes to the right is the end. Then we paint the bar in either red or in green. It is red if the close this period is lower than the close on the last. So if it went down from close to close. The next one is green because after closing here, it closed up here. It went up day over day. We'll find that that's the case for a bar chart. When I switch this back to the candlestick, which I prefer for a number of reasons, not least of which is the fact that there's more ink on the canvas, as it were, making it easier for you to see at home. But our lines here are the open up here and the close down here. I know that this one up here at the top is the open because the candle is red. It is red because from the open to the close, we went down. This next one is green, not because from close to close we went up, but because it opened at the lower part of that body of the candle and closed at the upper part of the candle. It's the from start to finish instead of from finish line to finish line comparison that matters when we look at a chart here on our candlesticks. We can see evidence of that right here on March 11th, where we closed here and then closed up here. That's an upwards movement. And so our bar chart had this day painted in green because it looks at close to close. Whereas our candlesticks, notice that we opened slightly higher, then ended up closing here. That's a lot of information in one brush stroke that we can learn from these charts. And that's why they are used. They give us such an amazing insight into the sentiment. Let's think about this one over here on March the 14th. After closing down here, Apple opens higher than we were for most of the trading day previously. Then we open here, and at some point, we rocketed all the way up to 174 and change. We came down to 171 at some point. But by the end of the day, there was no decisive winner amongst buyers and sellers. We ended up closing right back here where we opened, right in the middle of the day. All from one candlestick. That's a lot of information that we can learn. That's why we use candlestick charts, and the overall idea is that then we can start asking ourselves, why would this occur? Does the fact that we started slightly higher, then tried up, tried down, and couldn't move tell you anything about investor sentiment today? It tells me something. It tells me that there wasn't a decisive reason for the market to continue to go higher. Traders said this appears to be high enough. If we had to label this as bullish or bearish, I would instead label this as indecisive. We stayed right here in the middle. And there's a name for this that we'll learn in a couple weeks. But that's what we are trying to accomplish when we use chart-based analysis, is to learn what's happening on the chart over time. There is a fourth one listed here. This is mostly as a nod to the long distant past, but point and figure charts are a way to measure out long-term trends and look at only moving from one column to the next on the basis of a large movement in the other direction. So we'll kind of leave those behind us. But that's the basic idea in some of these charts. You will be able to use any one of these that you prefer. All of them are available here at Fidelity. We make them easily accessible to you, and we'll show you more and more how to access those and use them over time. But Nick, I'll let you go ahead and walk us through anything you'd like on additional details for these if you feel it's necessary.
Sure, Jacob, I just want to hit something again on the Apple chart that you had pulled up. I didn't catch if you'd mentioned this, but I just wanted to repeat this. I want to point out that big green bar that's on the far right-hand side. Jake, if you could add, actually remove the average true range percent and add volume onto that for us instead. And typically when you pull up a regular chart with AccuTrader Pro, it'll already have volume in unless you close it out. But I want to point out that big green bar has a red volume. Why is this? Another example is that third candlestick from the left.
Yeah, we did talk about it on this one over here,
yeah,
Nick. But yeah, that's a great visual,
exactly.
Right?
It's a great visual. And yes, that was a red candlestick, but the stock was up for the day on that. Can you shift over to the open, high, low, close for us?
Yeah, we did show it as well, Nick. So
Yeah.
what Nick's getting at here, folks, is the volume bars match the coloring on those bar charts, the ones with just the tick marks. Green here, like we talked about, but red on the candle because of that open to close. Over here, green with red because we went down over the course. A great little section that I happened to zoom in on arbitrarily there, Nick. Two examples of it.
Yeah. So, something else I want to show is just also the visibility. And so if you could take us back to a bar chart, and maybe we zoom out to 6 months, and even really on this 1 week, it's hard to see, but you can see as we then get further and further back, it's harder to see everything. It's harder to see the colors and such, especially if you change everything to be just black and white. Compared to candlesticks that are filled in, it makes it easier to see the different colors on here. Those red and the green pop out. Traditionally, you'll have the down days will be filled in and the up days will be hollow. And so this really makes things pop out, like if we're drawing everything in a black pen or a blue pen or something like that to see those differences in the days. And so I just wanted to address that a little bit, Jacob, as we went along. And there are some other differences as well with the Eastern technical analysis versus Western. And this gets into what Jacob was saying on that one candlestick where we went way up, way down, but closed right about the same time, right about the same price. What does that mean? Just like how many of you might be familiar with the concept of a head and shoulders or those kind of topping patterns or shapes and all that. That's Western technical analysis. Eastern technical analysis starts to get into candlestick patterns. The significance of having a red candle following a green candle, or a green candle following a red candle, or is one bigger than some of those significance is that you don't really see with the Western technical analysis. So I just wanted to touch on the volume corresponding with an up or down day, but also some of the visibility issues with the different chart types.
Perfect. Thanks, Nick, for the addition. So here on our bar charts, like we said, the volume is going to be included as well. That's visible on all the different chart types with the exception of the point and figure. But like I said, since that's a remnant of a bygone era, largely, we're not going to focus on that version. Bar charts are those open, high, low, close. They're going to give us that same information, as is the candlestick. Both of them going to include those. But the big difference is because of that visibility, it does make it a little bit easier in some ways. There's many different varieties, and you are welcome to choose whichever one you happen to prefer. But now you've seen Nick and myself have a bias towards these filled candlesticks, partly for visibility purposes for you to see, but I also like the fact that it calls out that intraday change in behavior as well. You make your own determination as to what you might look at. But now we're going to start focusing in on what we are going to call significant or important on that chart. If we're looking at all that information, at one point I was showing you 10 years worth of daily information for Apple. What's important there? Well, frankly, it's not too important if we continue to go the same direction on the chart. We are more interested in when something changes. And we're going to call those reversal points. And you can apply this in the same way to the times when you went on a road trip with your family or even solo. It's not quite so notable when you continue with cruise control at 65 or 70 or 75 miles per hour down the interstate. It is notable when the person in front of you slams on their brakes. That change is what stands out and requires action from you and additional thought. You can almost go on auto drive there when you're cruising along with no change. The reversals, the changes, the stops are what we are constantly watching for and recognizing as significant both in present time as well as we look back with the benefit of hindsight over the past. As a result, we're going to label these with a few different names. Reversal points is going to include both tops and bottoms, but we're going to call the tops peaks, calling them like mountains. There's a peak to each mountain, and that's what we're going to notice. We're going to look for those peaks as an area where buyers were in control. They were pushing the price up, 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 and then it went too high, and sellers pushed it right back down. Somebody pumped the brakes. Likewise, a trough, we're going to call those low points where the price had come down, 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 and then buyers come out in force and say, this is a great price. I'm going to buy, and the price goes right back upwards. Reversal points are the foundations of trends, trend lines, channels, patterns, and support and resistance. We listed down there at the bottom. Those are all foreign topics, but we're going to make them very commonplace to you here shortly. The idea is this. Let's watch what the price does. We start over here at the left and that it's going up, up, up. And what we're watching for is this peak. The price was going up, then it stopped going up. It was going up, and look, it stops at almost the same price that it was at previously. So we could learn something if we apply the reality that this is a marketplace of humans. What's happening here? Buyers came and bought until the price got over here to about $20 per share. And when it got to that price last time, people said that's too expensive. Buyers dried up. There wasn't more excitement for buying. Instead, sellers were in control, pushing the price back down. In this case, back down to about $15 per share. But then we see it go up again. And what happens when it gets near $20 per share? Well, almost predictably, we see that the price pauses here. We didn't know it would, but we knew it did last time. So it was reasonable to say that we should watch to see what happens at 20. Last time I got here, there was something going on. But in this case, the price pushed higher, breaking above the previous peak, going up, 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 and in this case, putting in a new higher peak. Then it came back down. And then same idea. We're watching to see what happens if and when it gets to that same area. We don't know it's going to go higher and put in a new peak C until after the fact. What we knew is last time, this is as high as it got. Be watching, be on guard. It's similar to pulling up to an intersection. I don't know that there's going to be a car there, but I know it's a possibility. I should probably be looking around more than when I'm on the regular interstate. We get up here, we put in a new peak, and it continues over and over again. Looking at those peaks is really about understanding what's happening in the marketplace. Bring it back to what people are doing. That's what we're interested in over time. But when we start putting the line of peaks in a row or troughs in a row, that's what we're going to call a trend. You've heard this term in many different places, but in the context of technical analysis, a trend is all about the interaction of buyers and sellers. And our goal as a technical analyst, remember, is not to predict the future and say, this is what the price will do. It's actually this. This is my goal as a technical analyst. My goal is to benefit from the continuation of a trend. If the trend is that the stock is going upwards, I can hop on that train and profit as long as it continues in the same direction. I could buy. But if instead we observe that the train is going downhill, down, 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 well, it might be time to get off that particular train and instead allow that trend to run itself out before becoming a buyer. Or if you happen to be one interested in profiting from downward price movements, you could use what they call short selling, but we won't dive into that in this course. The goal is to make profit from that continuation in that trending behavior. And those trends do change over time. They're going to move up, then they're going to move down, they're going to move left, they're going to move right. And over time, we're going to see that interaction moving side to side to side. So let's talk about some of the assumptions that come in when we use a trend. The first one is that as a technical analyst, we're going to assume first and foremost that the price now is the fair price, but that the price tends to move in observable trends, and that those trends tend to continue rather than reverse. I like to think of this almost like those Newtonian laws, that an object in motion will remain in motion unless, it doesn't say it's going to happen forever, unless acted upon by some outside force, right? And that's the key that we're thinking about. In a trend, we're just saying that this is moving with some amount of non-physical momentum. But that momentum is nonetheless real. It has a positive and measurable value. It needs to have something occur in order for that momentum to dry up. That's what a technical analyst says. Trends are going to be influenced by the shorter and longer versions. And you can think of this almost like zooming out to think about a wave in the ocean. There is small little ripples. There is the waves that come in over and over every few seconds. And there's the tides that come in and out over the course of hours each day. The trend should be looked at in retrospect to each of those varieties. The very, very short-term ripple, you can bet it's going to get carried farther if it happens to be on the back of a wave coming in. And if the tide happens to be coming in all at once, well, that ripple is a lot stronger. We're going to look at the lining up of those different time frames. Here, when we're talking about ripples, we might be thinking about 1 day's worth of trading activity. The wave might be a week or a month's worth, and that longer term tide might be the course of several weeks or months looking at over a long period, maybe even years or months. But as we think about that, the relative variety, we should look at the shorter version of trend, zoom in a little further. We should also zoom out and understand how does this relate over time. We looked at Apple briefly, and let me just give you an idea what this would mean on a chart like Apple's. Here we've got, over the course of the last year, some movements down, some movements up, some movements down, some movements up. At any point, I could look at the part that's going up and say, it's going up. Factually accurate. It's going up. But in the broader scheme, zooming out, it was going down. Even though my wave was coming in, my tide was going out. That's going to affect my trading activity. I should recognize that I am trading while the tide is going out. And if so, I should make my decisions based upon that observance. But what occurred today after earnings come out, it appears that we're in a brand new territory that hasn't been played with in several months. The existing trends may have been thrown right on out, and now we need to start fresh. That tells us we've seen something change. Remember, trends tend to continue rather than reverse. There needs to be something that pushes it out. Sometimes it's a notable and even known upcoming event, like an earnings announcement. In other points, it will be just the culmination of buyers getting tapped out. They've used up all of their money over time, and now they're sitting on the shares and hoping they continue to rise. But sellers start showing up in the marketplace and pushing the price down. So, folks, that's what a trend is. Nick, maybe you can help us understand how we would determine whether it's an uptrend, whether it's a downtrend, and even move us into trend lines, if you'd be so kind.
Something I like to, discuss and talk about when we get into trends is, there are some pillars of technical analysis that we refer to. We have trend, you have momentum, and then of course volume. Trend is like speed. How fast are you going, but also what direction are you going? You get momentum is, are you accelerating or are you decelerating? But you might be accelerating for quite a bit of time as you get on the highway before you come up to speed and you're still going in the same direction. Likewise with that, with the longer term, shorter term, intermediate term trends, I also like to talk about boats. We have a big cruise liner. Can it turn around and go the other direction? Absolutely. But does it take a lot of time to do so? And is it kind of obvious that it's starting to turn? Well, yeah. What about a speedboat? Well, it can just turn on a dime. And that might be the equivalent to looking at this bigger picture, this full chart. This is like a cruise liner. It takes some time to show that it's turning around. Little smaller dips that we see. We see 2, 3 dips even before that first green circle circling the first top. Those can be those little speedboats going whoop this way, back and forth, so to speak. But the other thing about trends, though, is that they're not always just up. Sometimes they're down. Sometimes they're sideways. And actually, a significant portion of the time, a stock is actually in a trendless environment. The image we have, the quick screenshot we have, is a great example of a stock in an uptrend. What defines an uptrend? Well, it's a security that is making higher highs and higher lows. And that's what we're trying to illustrate with some of these circles of these reversal points. Circling those reversal points that we're talking about earlier on is a great way to start to identify a trend if you're not already to the point where you don't need to circle them. But as we can see, each successful reversal on the top and where it reverses down is higher and higher and higher. And each successive reversal as it drops is higher and higher and higher. We have higher highs and higher lows. This is showing an uptrend. And then I know on the next slide, we have an example of a downtrend. It's similar, but not. We're still circling on the reversal points, but a downtrend is defined as lower lows and lower highs. And we can see each time this dips down, it dips down lower and lower and lower. And we do have some examples of this within the slide deck, but if you're to zoom in, like what Jake was saying, on that first time where it bottoms out and comes back up, well, that actually looks like a intermediate term uptrend. And even in that, as it bottoms out, it comes back up, it drops, and then it peaks. So you have that even shorter term downtrend and uptrend within the intermediate term uptrend that's within the longer term downtrend with this. And so this kind of comes back to an extent with trend, it's important not to miss the forest for the trees. And you can also think of trend as that headwind or tailwind. Can a security that looks like this go up? Absolutely. But is it more likely to go up, or is it more likely to continue down? That's kind of the other question. And a successful trend trader, they're going to want to see evidence of a reversal in trend before they might enter the trade. And this becomes really, really important, really critical with this. And this goes back to, again, Dow theory, identifying trends that, what a successful trend trader might look to do is if they can capture the middle 60% of a trend, that's what they're looking to accomplish. If they're looking to be long, so to speak, the security will bottom out and will come back up, and they'll miss the bottom 20% because it's going to come back enough to show, hey, look, we're having higher highs, higher lows. That's when a trader might enter. And then it tops out. Well, they're not going to be able to sell. You're not looking to identify the very, very top. Well, have topped out and it'll come back down, showing that maybe the trend is now over. And so you miss out on the top 20%, capturing that middle 60%. Now, how might this differ than simply being long? Well, frequently a trader might look to remove a little bit of portfolio volatility. That you could just set it and forget it and just be long, so to speak. But with that, traders have found that if they can just trade with the trend and capture that middle 60%, they can then enjoy most of the upside participation of a security, but have a lot less exposure to portfolio volatility. So the next slide we show kind of that trendless environment that's that I was talking about and such. This is where it's just going sideways. And a great example of this is dealing with the Russell 2000 index. Looking at the Russell 2000 in, I think it was 2021. After everything bottomed out due to COVID, came back up. The Russell just kind of moved sideways. It didn't really do anything on that. We see it's a great example of that. Thank you, Jacob. We're just kind of go sideways. It was trendless. Before that, it was very obviously in an uptrend. Bottomed out, higher highs, higher lows. But then it peaked, and then it couldn't hit a new higher high, and it couldn't hit a new higher high, but it also wasn't hitting a new lower low. This is a great example of a trendless environment. And then since then, we then had Russell drop down, enter a downtrend, and then trend sideways again. Now, of course, the range it's been exhibiting more recently over the last couple of years is a little bit more than what it exhibited in 2021. But this is a great example of a security that is in a trendless environment. Jacob, just to kind of shift things over, could you show the S&P 500 over the same time frame? And we see, well, it dropped, and this looks a little bit more obvious where uptrend peaked about there, and then 2022 downtrend, and then bottomed out, and then uptrend. And you could even say the entire kind of right third of the chart is an uptrend. You can go uptrend and then a little downtrend, then uptrend. Different traders will look and identify different things, but this provides a really good example of it. To an extent, this was more trending, or during the same time frames, the Russell 2000 was not trending. And I think really understanding the concepts of trend, understanding then those reversal points, starting to identify support resistance. This is just foundational, fundamental for a technical analyst. Those reversal points where you'll see a security bounce off of, especially in a trendless environment, becomes really, really, really important. The other aspect of identifying those reversal points is traders will also start to connect those reversal points to form a trend line. And on slide 30, we have a great example of this with an uptrend, kind of connecting that bounce low, bounce low, bounce low, bounce low, and the more touches you have like this, the stronger the trend line. And the stronger the trend line being that if it has 5 touches like this, well, traders will feel it's more likely to bounce again the next time it touches. Or if it's only 2 or 3, well, it only has a couple, it's not going to be as strong. It can be more likely to break compared to bounce as compared to something that has 5 touches, so to speak. So this is a great example of an uptrend, an upward sloping trend line. On the next slide, we have an example of a downward sloping trend line where you're doing the same thing. You're just connecting those tops as they go down. And then we have an example of that trendless where it's kind of bouncing back and forth. Those two, bouncing between support and resistance on the next slide showing the trendless environment. And really, we'd pull up the Russell to show a great example of that on an actual security showing that trendless environment.
The key here, folks, is to bring it in and ask yourselves again, why does this happen? It's not magic. It didn't have to happen. And on the 5th time, it certainly could have instead gone up and not reversed, right? But the fact is that it didn't the last few times. So when you saw the price flattening out and coming over close to this line again, your first thought is last time and the time before and the time before and the time before, that was as far as the price moved in that direction. It would be reasonable to say I should at least be alert and watching to see where it goes this time. So far, 5 times in a row, it's seeming like it only goes down. But at some point, it will likely turn around. It can't go further down than 0, after all, and we're all the way down at $2 per share. Not a lot of additional down available to us at that point. Always bring it back, folks, to what are we trying to learn? This isn't magic. When we looked at the uptrend line, you might have noticed that it's drawn in down here off of the troughs, the lower parts. Whereas on our downtrend, we're looking at the peaks. I like to think of this as when you're driving on the road, they put a guardrail on the side where if you fell off the road, your car would keep falling and falling, right? I grew up in Utah with high mountains all around me. You drive up in a canyon, there's going to be a guardrail on one side of the road and only on one side. It's the side that goes down, down, down and includes real trouble. That's what's happening here. When you draw in your trend line, this is your guardrail that says, yep, everything's good. Trend is continuing unless we see something on the wrong side of that guardrail. Once it's on the wrong side of that guardrail, trouble ensues. A change, not necessarily a fall down to a very tumultuous end, but at least a change. Somebody's pumping the brakes, okay? That's what we're looking at on here. So let's go ahead and spend just one moment looking at that on a chart and drawing them in. This is one of the harder parts for a new technical analyst, and I know that that's the case. Nick, you and I have both witnessed that for many years. A few of you were asking very similar questions, wondering what time frame should I be looking at for a trend? There isn't a right trend. If you wanted to zoom in and look at the very shortest time frame we offer at 1 minute, and we'll go ahead and adjust this to show just today's information, we could find right here a small uptrend, an opportunity to profit so long as that trend continues. In this case, with 1, 2, 3, maybe 4 touches. you could find a very small downtrend as well. But finding where to draw these lines in is often difficult for a new trader. And so what I will encourage you to do, folks, is to pull out a chart for any stock that you're interested in and just ask yourself on the time frame you're thinking about trading. Maybe you're going to trade for the next 6 months. Okay, look at a 6-month chart as a starting point and look for those peaks, the reversal points, the troughs, and then just draw a line connecting the peaks. Draw a line connecting troughs. If the lines point downwards, folks, it's probably not an uptrend. If the lines point upwards, it's probably an uptrend. That's what we're looking at. But when they don't agree or they move sideways, that's what we call trendless or sideways trending. Now, we are 5 minutes to the close of the hour, and this has been a lot of information. Does anybody feel like they got a ton of information in this class? I hope you did, and I hope it wasn't overwhelming. But this is a lot of information. This is why we split this first set of slides into 2 weeks worth of material. Believe it or not, we've got more to go next week. Same time, we'll be right back here at noon next Friday to talk about a continuation of these same ideas. Where do we go next? Today, we learned what it is and what a trend line is. We learned about trends and our assumptions as technical analysts. I hope you can see that there's value in these. You can see the observable trends. But let me go ahead and talk a few administrative items that we need to discuss before we close out for the day today. I'm going to go ahead and bring over for us Fidelity.com. I haven't even logged in, so this is just like you just went to the website. Here, we're going to come to News and Research. Come down a little ways over here to Learn, down at the very bottom. News and Research, then Learn. This is our learning center. It's got all sorts of good resources, but one of the most important, especially for today's discussion, is right here under Events. Nick and myself and our team are the trading strategy desk. And you'll notice we've got trading strategy desk coaching sessions. These happen all day, every day, including something at the start and end of every trading day to talk about the current events. Why is Apple up 7%? What else is going on in the major markets moving us one direction or another? All of that is discussed repeatedly. If that's of interest to you, join us in those market briefings, is what we call them. But here in classes is where we sit today. Our classes are all about diving in a more defined curriculum, building week over week over week. And today we are in the technical analysis course. Again, that was News and Research, then Learn. We clicked on Events and then Classes down here at the bottom. Here, we will go ahead and use the technical analysis link to learn more and register. There are a few different pages you might have made your way to in order to register for today's class, but follow those steps I just gave you for 2 reasons. Reason number 1, folks, is because it's got a slide download access. This will give you the slides for not only today, the same ones we will also be using next week, but also week 3 and week 4. It's going to give you all of it in one nice download, 100 plus slides that you can keep for your reference if you choose to do so. Then, second, I will point out that we've got links here for a few other items. These are hyperlinks as well at week 1, week 2, and week 3. These are your homework assignment. Yes, you're back in grade school, folks. You're going home with some homework. You do not have to do it, but we strongly encourage it. We find those who do use this homework, let these ideas sink in a little faster. Your call, but next week when we start up, we're going to review that to get us back in the mode, remind ourselves what we learned, and move on with new information. You'll click week 1. You'll see it downloads a PDF for you. You can answer these couple of quick questions. It probably won't take you more than 5 minutes, but go ahead and do those at some point in the next week to keep these ideas fresh in your mind and maybe point out something you may have missed. If so, bring those questions to us next week. We'll be happy to address them. Next week is May 10th. We're going to be back here at the same time. Now, we do offer you the ability to go in and register for all of these. Maybe, Nick, you could confirm for me whether the folks need to register for each individual session or if that's changed. My memory is failing me there.
For when you come to this classroom page right here, you only have to register once and you receive a reminder email for all 4 sessions. Now, if you go to fidelity.com/coaching, where our one-off coaching sessions are, that's where you'll actually see a week 1, week 2, week 3. And if you do it that way, you will need to register for each session individually. But if you're at fidelity.com/classrooms, this is a register at one place, and you'll receive the invitation email for all 4 sessions.
Excellent. And we did have some requests on how to watch a replay to be able to go through this. These classes are recorded, but they are recorded exclusively for compliance verification. It won't be published or sent out to you hereafter. I wish that was something offered. It's simply not. However, there is a lot of recorded material, including a version of this class on fidelity.com. So if you go ahead and come here to the website, let me see if I can stretch my brain to remind myself. I think it's getting started with technical analysis.
And I also will search for like technical analysis series and such, but I think the introduction to technical analysis or the getting started will both of that.
Let's see, that one is
that's
options.
getting
I just
started with
clicked on.
options. Yeah, do the introduction to technical analysis.
Yeah, these ones have got some real nice short clips telling you all about what's happening in the technical analysis world. I'll see if I can dig up the link specifically to the recorded version of this same content that we just discussed today. But folks, there is a whole bunch of that available. I'll make sure I have that prepared for us next week. But folks, thank you for being here with us. We are officially at time. We typically try to keep close to exactly this hour, but we will try and answer what questions we can hereafter when there is questions that are on topic. So let's go ahead and address one of those questions. Jenny asks, why is today's Apple red bar not green? Let's go ahead and swing over to that chart so we could take a look at it. So here's our chart, and I have on my screen this one representing today. You know that every one of these is one day because down here at the bottom, I've selected a frequency of daily. Each one is one day. So today's is red, Jenny, because we opened our trading higher than we are trading currently. Remember, this is a candlestick, which is based upon the the trade direction from the open to the close. You can look at the specific numbers by using these values here in the top left-hand corner. They will change what number they show based on where my mouse is, left to right. Do you see how those numbers are changing? If I bring my mouse over to this, but you keep your eyes in that top left-hand corner, it will give you that update on the current prices. The open was $186.65, but it did go as high as 187, as low as 182, and right now we're at 184. Because 186 is higher than 184, it's painted in red, telling us that intraday direction is down. We notice that our volume bar is green. And if we were using instead that bar chart, the open, high, low, close, the one with the little tick marks left and right, that would be a green bar because it instead compares yesterday's close to today's close as a comparison for its directional coloring. So hopefully that makes sense, Jenny. We'll go ahead and address maybe one or two close final questions here. Why is the close price lower than the open, even though the volume is green? Good question. So the price currently is that price because two traders agreed that was the right price. A buyer said, I'll buy, and a seller said, I'll sell at 184.62. Handshake is made and a deal is traded. Since people were trading at higher prices this morning, that's why we're at a lower price this morning. It doesn't mean it always will occur this way. But remember, this is the history of actual completed traded transactions in the past. All right, let's see. It looks like most of the other questions are just related to some of the administrative items. We had a question from Hung wondering, is there a cost for the coaching classes? Great question. You will get substantial value out of them, but no, we do not charge you for them. They are freely available to any Fidelity customer. Head to fidelity.com, go ahead and click into those. They're available at no cost. Nick and myself are your captive teachers. You are captive audience. Thank you so much for joining with us. Let's see, and it looks like That wraps up the majority of these. Christine just does point out, if you want to download the a link and add it to your own digital calendar, registering for each week's course individually is the way to go. That's absolutely true.
Yes.
Otherwise, if you use the month-long one, it's just not quite smart enough to give you 4 separate reminders over time. Folks, thanks so much. We'll look forward to seeing you back here. I hope you've gotten enough value that you'll join Nick and myself next week when we talk about support and resistance. How do we make some of these trade decisions, continuing to build upon what we've already discussed today. Thank you again, and we appreciate the time that you have spent with us so far already and look forward to the next week. Until then, have a phenomenal weekend. If you try out any trading, be safe out there. Make sure you're watching closely for those reversal points. That's what we're all about in the trend trading business. Thanks so much, folks. Thanks, Nick.
One last thought. If you search on Fidelity.com for technical analysis webinar series, the very first session that comes up is technical analysis part 1, the building blocks, and that's going to be a recorded version of this class. I know our technical analysis classes, yeah.
Technical analysis webinar series.
Yes.
See if I can zoom in there, folks. Technical analysis webinar series, he says. Let's see if he's right. And it's this first one, sure enough. That's the magic keyword there, folks. Technical analysis. Analysis webinar series. If you click on that first result right here, this is a recorded version, same material, but you'll notice that it's got for us that first of those classes going through all the same things we just did today, although it is on an older version of those slides. Other than that, same material. So great. Thanks, Nick, for digging that up for us. Folks, we appreciate your time. Thanks for being with us. We'll see you back here next week.